On October 21st, 2025, gold dropped almost 6% in a single day. That was the biggest daily loss in 12 years. Traders who'd been buying every dip for months, watching gold rip from 3,500 to over 4,300, suddenly got wiped out in a few hours. And here's the part almost nobody talks about. Right before that crash, gold had spiked to an intraday high near 4,380 before slamming back down. Retail traders were buying that top, convinced it was going higher. At almost the exact same moment, big money was selling into them. Same chart, opposite outcome. And the thing that separated the two sides was one concept that almost nobody teaches correctly: order blocks. You've probably heard the term, it's all over trading content right now. But most of what you've seen is wrong, or so oversimplified it gets people hurt. So in this video, I'm going to show you what an order block actually is, why gold specifically respects them so well, how to find the real ones and ignore the fake ones, and how to tell where big money is genuinely buying instead of where you just hope they are. Not financial advice, just education. Let's get into it. Start with a simple question. When an institution wants to buy gold, how much are we talking about? Not a few contracts. A serious desk might need to fill hundreds of millions of dollars in exposure. Now here's the problem. Gold is deep, but it's not infinite. If that desk sends one giant market order, price runs away from them instantly. Every tick they buy pushes the next fill higher, and their average entry gets worse and worse. By the time they're done, they've moved the market against themselves and paid a terrible price. No professional does this. It's amateur hour. So what do they do instead? They wait. They build their position in a tight zone, quietly absorbing everything the market throws at them before price makes its real move. That zone, the place where a large player loaded up before a strong directional push, is what we call an order block. It's not a magic line. It's the footprint left behind when someone with real size did their buying. Here's how you actually spot one on a chart. Look for a strong, aggressive move away from a level. On gold, that's usually a series of big candles that break structure and leave everything behind. Now look at the base right before that move started. Very often you'll see a small consolidation or a single candle in the opposite direction of the move that followed. On a bullish order block, that's the last down candle before price exploded up. That last down candle is the fingerprint. It's where the institution was absorbing all the selling, filling their buy orders right before they let price go. Think of it like a coiled spring. The consolidation before the move is the compression, the explosion out is the release, and the level where the spring was compressed, that's the zone price tends to remember. Why does it remember? Because the institution didn't get their entire position filled the first time. This is the part retail almost never understands. When price rockets away from an order block, the big player usually still has unfilled orders sitting in that zone. They wanted more than the market gave them, so when price eventually drifts back down to that level, those resting orders are still there waiting. Price touches the zone, the remaining orders get filled, and the market pushes away again. That's why a clean order block can hold multiple times before it finally breaks. Now, why gold specifically? Gold behaves beautifully around these zones for a few reasons. It's one of the most heavily traded, most liquid instruments in the world, which means institutional footprints are cleaner and more meaningful. It also runs on very clear session behavior. The Asian session tends to be quiet and range bound. London brings the first real expansion. New York often delivers the violent, decisive moves. A lot of the best order blocks on gold form during that London-New York overlap because that's when the real money is active. If you're marking zones on gold, pay attention to what session created them. A block built during dead Asian hours is far weaker than one built when the whole world was trading. Let me walk you through what this looks like in practice, because the theory is useless if you can't see it live. Price has been grinding sideways through the Asian session. London opens. Suddenly you get a sharp drop, a stop run below the range that shakes out everyone who bought the bottom. Then right at the lows, a single strong bullish candle forms and price rips higher, breaking the top of the range and taking off. Most traders look at that and think, I missed it, and they chase. They buy at the top of the move, right where it's already run 200 pips. The professional does the opposite. They mark the origin. They go back to that last down candle before the explosion, the base of the move, and they wait. Price runs up, stalls, and starts pulling back. It drifts down back toward that zone, And as it touches the order block, the remaining institutional orders fill, buyers step in, and price pushes away again. The retail trader who chased the top is now underwater. The trader who waited at the origin got a clean entry with a tight stop because they bought where big money bought, not where big money was already unloading. That's the whole game. Buy where they bought, not where the move already happened. Now, I need to be honest with you because this is where a lot of content lies to make it sound easy. Not every consolidation is an order block. Not every zone holds. The internet is full of people drawing rectangles all over their charts after the fact. And of course, it looks like it works when you already know the answer. Real trading is harder than that. So let's talk about how to filter the real ones from the noise. The first filter is the strength of the move that followed. A genuine order block produces a violent, decisive departure. If price kind of wandered up slowly after your zone, that's not institutional buying. That's just drift. You want to see aggression, big candles, a clean break of structure. The stronger the reaction away from the zone, the more meaningful the zone. The second filter is liquidity. And this is the piece that ties everything together. The best order blocks form right after a liquidity grab. Remember that stop run below the Asian range I mentioned? That wasn't random. Before big money can buy, they need sellers to buy from. So price often dips below an obvious low first, triggering a flood of stop losses and panic selling. And that selling is exactly the fuel the institution needs to fill their buy orders. The order block forms right there at the low, right after the sweep. So when you see a zone that formed immediately after price raided an obvious level, that's a much higher quality block than one that appeared out of nowhere. Here's the mental model. Retail traders ask, where's the pattern? Professionals ask, where's the liquidity? And where did someone step in right after they took it? The order block is where they stepped in. The liquidity grab is why they were able to. The third filter is whether the zone is fresh. An order block that price has already returned to and reacted from is partially spent. Those resting orders have mostly been filled. The cleanest reactions usually come the first time price returns to a fresh zone. After that, each retest gets weaker until eventually the level breaks entirely and price moves through it like it's not even there. When that happens, don't fight it. A broken order block isn't a discount, it's a message. The players who defended that level are gone. Let me give you a concrete way to use all of this without overcomplicating it. Wait for a session that matters. London or New York. Watch for price to sweep an obvious high or low, some level where you know retail stops are sitting. After the sweep, look for a strong reversal and a break of structure in the other direction. Mark the origin of that move, the last opposite candle before the explosion. That's your order block, then be patient. Do not chase, let price come back to you. When it returns to the zone, you're looking for confirmation that buyers are actually there. A strong rejection, a shift on the lower time frame, something that shows the orders are filling. Your stop goes just beyond the zone, because if price closes cleanly through it, your idea was wrong and you want out cheap. Your target is the liquidity on the other side, the highs that haven't been taken yet. Notice what that structure does for you. Your risk is small because you're entering at the origin instead of chasing. Your reward is large because you're aiming for the next pool of liquidity. That asymmetry, small risk for a shot at a big move, is the entire reason professionals trade this way. They're not smarter than you. They're just entering in better locations. Now, a few honest warnings, because I'd rather you survive than blow an account chasing a concept. Order blocks are not a guarantee. Nothing in trading is. Sometimes a beautiful zone forms, price comes back and slices straight through it. That's normal. That's why you use a stop. Anyone who tells you a setup works every time is selling you something. The edge isn't in being right every time. It's in risking little when you're wrong and capturing a lot when you're right. Don't mark 20 zones on your chart. If everything is an order block, nothing is. Force yourself to only mark the ones that came from a strong move after a liquidity grab on a session that matters. One clean zone is worth more than a screen full of hopeful rectangles. And don't force it on days when gold isn't giving you anything. Some sessions are messy. Price chops, sweeps both directions, respects nothing. On those days, the professional move is to do nothing at all. The market will still be here tomorrow. Your capital needs to be here too. Let me leave you with the shift that actually matters, because the specific rules are less important than this. Most traders look at a chart and see shapes, rectangles, lines, patterns. They think the shape is the thing, but the shape is just the aftermath. What you're really trying to see is behavior. The moment a large player made a decision and left a mark. The order block isn't a drawing. It's a location where big money committed real capital and often has more capital still waiting. When you start seeing zones that way, not as patterns but as decisions, your entries change completely. You stop chasing moves that already happened and you start positioning where the next move is likely to begin. That's the difference between buying gold at the top of a run because you're afraid to miss it and buying it at the origin because you understand who was there before you. So here's my question for you, and drop it in the comments. On gold, which do you find more reliable? Order blocks that form during the London session or the ones that form in New York? I'm genuinely curious what you're all seeing, because the session behavior is something most people never pay attention to. Let me know below. If this helped you see the chart a little differently, subscribe, because that's how the channel grows and it's all I ask. I'll see you in the next one. Stay disciplined.